I'm going to show you how you can use this to become a better investor so we can make some money together. Now, what do I do with my 25 shares? So we're going to go and ask Perplexity. The 2-star rating suggests waiting for a better entry here.
Hey everyone, welcome back to the channel. Today I'm diving into Bloom Energy Corporation, a company at the forefront of clean energy and fuel cell innovation. I'll walk you through how I discovered this stock, why it jumped onto my radar, and what I'm doing now that the price has surged. If you're interested in innovative investing strategies and want to see fundamental research in action, stick around. Before we get started, let me introduce myself to any new viewers. My name is Warren. I'm passionate about finding innovative companies and sharing actionable investing insights with you. If you enjoy deep dives into stocks and strategies, make sure to subscribe. Please hit that like button. It helps the channel grow. How did I come across Bloom Energy? Well, barbell investing. You might be wondering, barbell investing? I kept hearing about this approach from respected investors, and it piqued my curiosity. I didn't know what it was. It made me want to explore more about what this approach means and how it could fit in my portfolio. Barbell investing splits your portfolio into two extremes: safe assets like bonds and cash, and risky growth assets like tech stocks and emerging markets. It avoids moderate risk assets to protect downside while capturing upside. I went into Perplexity and I gave some prompts, and it found me a Forbes summit. And I got a slideshow. Then I extracted that slideshow and I uploaded it into Perplexity, and I wanted it to analyze it for me to figure out if there was any assets that I could invest in based off this strategy. So as you can see down here on slide 4 in the growth sector right here, recommended AMD, Taiwan Semiconductor, and Bloom Energy. I really didn't know much about Bloom Energy. I further researched it more into Seeking Alpha and into Morningstar. I'm really bullish on natural gas as a bridge until nuclear power is ready, supporting the AI data center electrical demand. I went ahead and I bought 25 shares on June 9th. So here's my trade on June 9th for Bloom Energy. Just 25 shares at $21.63 a share for a total of $540. Just a taste to get going on this stock. I did do another trade here. Other stocks came up for this barbell strategy, AMD and Taiwan Semiconductor. So I haven't taken a position in AMD, but I did sell a cash secured put on Taiwan Semiconductor at 210 and got assigned when the stock closed a few weeks back at 209. I held the shares for a week. Then at the beginning of the second week, I sold a $227.50 cover call when the stock was trading around 220. Sure enough, it closed at 228. It was a weekly call. It was a $1,700 profit in 2 weeks. The stock sits around 231 a share. So I did not hit the bullseye, but a profit is a profit. If you are interested in learning more about this strategy, I wrote a few articles on it in my Substack. Check the description for that in my link. I offer free and premium subscriptions. Here's my disclaimer. This video is for educational purposes only. Please consult a financial advisor before making any stock picks. I do own a position in Bloom Energy. As you can see, Bloom surged earlier in the week on July 9th, about a month after I bought it, 18% after a JP Morgan analyst raised the target to $33, prompting for me to do this video. I'll show you tools I use to evaluate Bloom and develop a strategy. This channel will occasionally share stock analysis and portfolio management. Subscribers can suggest stocks, comment, and share feedback. I value your input as we will work to grow our wealth together. So let's go ahead and analyze Bloom. We'll first use Seeking Alpha and see what jumps out at us. Here's Seeking Alpha, Bloom Energy. For the sake of time, I'm going to show you their AI analyzer function. Here's how you bring it up. It's, as you can see right by the name, Analyze with AI. You go ahead and click on that. It's opening it up. Seeking Alpha combines crowdsourced insights with quantitative ratings. This is an entirely different perspective from traditional analyst reports. So let's break down what Seeking Alpha's numbers are telling us about Bloom stock. Right off the bat, you can see Seeking Alpha gives Bloom Energy a hold rating. But here's what's interesting. It's not because everything's mediocre. They're actually seeing a mixed bag of extremes. Right now, we see the company's description. What does all this mean? And I'm not really an engineer. So I really kind of wanted to figure out what this company did. I then went to Perplexity. And that's kind of the purpose of this channel. We're going to use Seeking Alpha and Morningstar to look at stock, but then we're going to also use AI. I found Perplexity to be the best finance AI out there on the market. I tried them all. Now we're going to go and use Perplexity, prompt it to figure out what this company does. I prompted it as I took that description from Seeking Alpha and I pasted that whole description. This is how it answers. Did all this research here, all these steps. It told me what it was, like if it's explaining to a 5-year-old. Imagine Bloom Energy as a company that makes magic boxes called Bloom boxes, which generate electricity in a cool, fireless reaction using ceramic plates and gas. They act like a special sandwich maker with green and black plates, producing safe electricity without smoke. Why are they special? No burning. Unlike cars or fireplaces, these boxes don't burn. Almost no pollution. They're super hot. They get hotter than your oven, but that helps them work better. What comes out? Electricity for lights, water, like steam from a kettle, a little carbon dioxide, but much less than burning things. Bloom Energy's electrolyzer reverses the process of its Bloom box using electricity to split water into hydrogen gas, a clean fuel, demonstrating their science of producing clean electricity without fire or smoke. Now let's go back to Seeking Alpha. We have their factor grades, evaluation of D minus, which is expensive. Growth is an A, which is excellent. Profitability is a C minus, below average, and momentum an A plus, which is really on fire. Revisions is a C, which is neutral. The D minus valuation signals it's costly with a PE ratio well above sector median, trading at a premium compared to their peers. They're given it an A for growth with 21% revenue increases year over year, far surpassing the sector average of 4%. Investors pay for this growth, but its sustainability is uncertain. So I want to investigate further this high PE ratio, the valuations. We're going to go back to Perplexity and do a prompt to further look at this red flag. I asked my AI assistant to analyze Bloom's valuation, focusing on the PE of 54. When in a trading view market beat Simple Wall Street Seeking Alpha, it revealed growth opportunities and risk. Interestingly, the company reported record Q1 2025 results with $326 million in revenue, up 38.6% year over year. Gross margins at 28.7%. They also achieved their first positive Q1 EPS at 3 cents a share, compared to a 17-cent loss last year. We'll do another prompt on that. I wanted to do some statistics since it was his first profit ever. So the growth story highlights it's all about the data center boom, with industry forecasts predicting 55 gigawatts of new capacity in 5 years. That's over 6 times of New York City's yearly energy use. By 2030, 30% of data centers will rely on on-site power, more than double now. Bloom Energy proved its worth with a $1 billion deal with American Electric Power, up to 1 gigawatts of fuel cells for AI data centers, and it grew its partnership with Equinix to over 100 megawatts across 19 centers. As you can see, the global fuel cell market is projected to grow from $5.6 billion in 2025 to $18 billion by 2030. So that's a 26.3 CAGR there, supporting Bloom's expansion. The risks we need to consider: despite a growth, analysts set a 24.34 price target, implying a 5.84% decline due to concerns about their valuation and sustainability. The company's negative 17.9% negative cash flow margin over 5 years raises significant doubts about converting growth into cash, posing long-term financial risk. Here's the brutal reality: the significant valuation premium means much of this positive growth story is already baked into the current price. Any slowdown in growth, competitive pressures, or broader market corrections could result in substantial downside. Last quarter, a company turned a profit for the first time in 16 years. I wanted to analyze what other companies' performance after their first profit. We're going to go on to the next prompt. Back in perplexity, can you give me some statistics or insight on stock performance for stocks that have never been profitable? In their last earnings report, they turned their first profit in company's history. I'm specifically analyzing Bloom Energy, but want to know about stock performance for stocks that have done this just like Bloom Energy has. So I want to see what performance stocks do after they post their first profit. So it gave me a chart here. It automatically produced, which is nice. You have Bloom, Tesla, Spotify, Netflix, and Uber. So you can see Tesla's the best performance after turning profit at 99%. Bloom's already up there at 85%. Well, you know what Tesla's done. A lot of people probably like this stock because it does have a lot of momentum. It tells me Tesla soared over 700% in 2020. Spotify shares climbed 13% in a single day and 150% over the past year. While Netflix achieved profitability much earlier in 2007, it demonstrated the long-term potential of companies that successfully transition from losses to profit. The stock has generated 54,000 returns over 2 decades. Wow. Boy, I hope some of you got a hold of that stock. I didn't, but I've owned it in the past. Average stock performance after turning profitable is 57.8%, median's 80%. Average years unprofitable before turning profit is 14.8 years. Old Bloom was 16. Study shows that positive earnings surprises typically lead to immediate stock price increases and continued drift over subsequent quarters. So I found this interesting. 42% of Russell 2000 companies are unprofitable. 14% of Russell mid-caps are unprofitable. And only 6% of S&P 500 companies are unprofitable. Research indicates that profitable companies outperform unprofitable ones by approximately 1.5% annually. However, during certain market conditions, unprofitable companies can experience dramatic rallies, with some gaining 36% on average. 80% of IPOs since the 80s have been unprofitable. Positive indicators: Bloom Energy's 85% stock performance aligns with historical patterns of similar companies. Conclusion: Bloom Energy stock performance following its first profitable quarter demonstrates a pattern consistent with other companies that have achieved similar milestones. The 85% stock appreciation places it among the better performing examples. The company's 16-year journey to profitability reflects the patience required for energy sector companies to achieve scale and operational efficiency. For investors considering similar opportunities, the data suggests that companies successfully transitioning from losses to profits can generate substantial returns. We just looked at Seeking Alpha's perspective on Bloom Energy. Now I want to shift gears and show you how Morningstar approaches this completely different. I have Morningstar up here, and I'm going to go over here to read company reports. I'm going to click on that. So here's the key difference, folks, about Seeking Alpha. It focuses on short-term factors like momentum and recent earnings revisions, updating daily to signal near-term price moves. Morningstar takes a long-term view at stocks, looking 10 to 20 years ahead, emphasizing future cash flows over quarterly earnings or short-term momentum. So Morningstar, it uses a discounted cash flow or DCF model to forecast stocks' future cash flow over 10 to 20 years. It discounts that back to the present value. reflecting inflation and opportunity costs. Morningstar values, in this case, Bloom at $15 a share. It means that the total future cash adjusted to today is $15 per share. This differs from Seeking Alpha, which emphasizes current momentum and factors. So let's dive into what Morningstar's analysts are actually seeing in their long-term crystal ball for this stock. Morningstar rates it as a 2-star. The price right now is about $25 a share, but the fair value is $15. So that's a 67% premium. Economic moat is none, which reveals no sustainable competitive advantage. A capital allocation is standard. So let's talk numbers. Bloom reached a record revenue of $1.47 billion in 2024, up 10.5%, with gross margins at 27.5%. While solid for manufacturing, they're still burning through cash and are barely profitable, which we just learned. The key metric is backlog and execution on this AEP deal. How quickly can they ramp production? Their manufacturing needs economies of scale to be profitable. The Morningstar's view is Bloom is well positioned for the data center boom and distributed power with the AEP deal, validating their technology at scale. But the stock is pricey. Relative to fundamentals at current prices reflect high future growth that may not occur. Out an economic moat, competitors risk eroding market share, and very high uncertainty leads to volatile valuations. For Bloom Energy, monitor execution on this AEP deal, and can they ramp up production and deployment? Second, more utility partnerships. AEP could lead to many more deals. Third, the margin improvement during scaling is vital for manufacturing. And fourth, regulatory changes could be big tailwinds or headwinds. Bottom line, Morningstar sees Bloom as a growing market player with potential, but the stock is priced for perfection. The 50% fair value increase reflects the AEP chance, but the 2-star rating suggests waiting for a better entry here. So now, what do I do with my 25 shares? So we're going to ask Perplexity. So back in Perplexity, like I said, I bought 25 shares of Bloom Energy on 6/9 for $21.63 a share. It is a small portion of my portfolio. I have a high risk tolerance. Please use these attachments and give me recommendations on what to do with the stock. Do I sell all, sell partial, hold, or buy more? What I did is I took from Seeking Alpha and the Morningstar, and I pasted that all in there. The funny thing about this is I did this prompt on Thursday, and it told me to sell half the shares and then keep the other half. But the stock sold off on Thursday and Friday. AI does change. Like, it looks at everything. So instead of telling me to sell, it's telling me now, based on your high risk tolerance and the fact Bloom Energy represents a small portion of your portfolio, I recommend to hold with select buying opportunities for your 25 share position. I'm up 17% on the stock, and it gives me a chart that's showing me what it's done here in the past year. It's volatile, which we know. It's a low of 9 all the way up to 30. My entry point was 21.63. Bloom Energy has demonstrated exceptional financial momentum in recent quarters, positioning itself as a leader in the expanding fuel cell market. It gives me a chart here on the energy revenue trend. Gross margin improvement 11% to 27.2. Then it goes into their competitors here. You have Bloom here, so you have market cap and the revenue growth and gross margin. You have Plug Power, Fuel Cell Energy, and Ballard Power. Against their peers, they're the largest company, but that revenue growth and gross margin is destroying these other companies. A company significantly outperforms key competitors across critical metrics: market cap, revenue growth, gross margin. Bloom's solid oxide fuel cells technology provides unique advantages for stationary power applications, particularly in data centers. Massive growth opportunity ahead. The hydrogen fuel cell market presents compelling long-term growth from 24 all the way up to 30. Look at that. Wow, that's a lot of growth there. The global hydrogen fuel cell market projects to grow from the 5.4 billion to 24 billion. AI data center, 300% 2030. They were uniquely positioned and capitalized on this growth. Mixed analyst sentiment. Analyst ratings, 47% have a buy and 28% have a hold. But this JP Morgan recently just upgraded the stock to 33. And it gives you sources here. Key risk factors to monitor. They do have a high debt to equity ratio, which I don't really like. The CFO recently resigned, which is always a concern. Geographic concentration in limited U.S. states and South Korea. Increased competitions coming and tariff headwinds. So there's some market risk here. Investment recommendations: strategic hold with opportunistic additions. Given your high risk tolerance, maintain a 2 to 3 year investment horizon to capture this AI infrastructure build out. A buy trigger. This is nice. Consider adding 10 to 15 shares if price drops below 22. Dollar cost averaging into high growth secular trend. Keep total BE position under 5% of your portfolio. It tells me to put a stop loss at 18. A profit taking, consider reducing position if the price gets above 30. Position monitoring. Watch Q2 2025 earnings July 31st and debt reduction progress. It's really giving me a roadmap and a strategy. These things are pretty smart. Bottom line, it represents a compelling investment in the AI infrastructure revolution and clean energy transition. That's going to sum it up this week. I'm going to ask you, what do you think? Are you buying Bloom Energy? Are you buying this story at these prices? What should I do? Should I listen to this AI? Should I hold? Let me know in the comments. Please smash that like button and subscribe for more stock analysis that helps us grow this channel. I want to help you guys out. Keep an eye out for our next video where I'll explain why I'm dollar cost averaging into a secret AI play. So hit that bell to get notification and subscribe. And thanks for watching. Please comment of anything you would like to see, or if there's a stock out there that you want me to look at for you. Thanks for watching, and I'll see you on the next video.
Stack it up real high. Come here to be in the know. Come here, enjoy the show. 'Cause it's Warren's money time.